All right. Good morning, all you magnificent melonheads of the world. Happy Friday, everybody. Today's January 3rd, 2025. Yo, we're only 3 days into 2025, and this year needs to chill TF out already. There's terrorist attacks and pipe bombs everywhere, planes flying into warehouses in California. Pace yourself, 2025. You're going to burn out too soon, all right? I mean, give it time. And yeah, I was all like optimistic about the second half of the 2020s was going to be great. We're on the back nine of this decade, and don't worry, things are only going to get better. Me and my big mouth. I just had to open it, right? Anyways, guys, going on this morning, the top story, it's a holdover from yesterday, is Tesla. Tesla's growth, it's just gone. And coincidentally, since I'm talking about this, my growth on Twitter is probably also going to be gone because I doubt Elon is going to like talking about this on his platform. But look, Tesla posted their annual deliveries number yesterday for 2024. And for the first time in the history of the company, Tesla delivered fewer vehicles than they did in the prior year. It wasn't a huge decline, all right? 1.79 million vehicles were delivered in 2024. That's versus 1.81 million delivered in 2023. So, I mean, essentially they were flat, right? It wasn't a huge decline, not that big a deal, but Tesla had done quite a bit, offering all kinds of discounts and 0% financing and things like that to try to cram as many sales as they could into the end of the year to make sure that number was positive, and they were not able to. All right, now, that's a problem only for Tesla. It's not a huge problem for everybody else in the auto industry. The whole other auto industry is having their issues. But with Tesla, when your stock trades at a multiple of 104 times earnings, you sure as hell better be showing some growth. Tesla is not showing growth, or at least not in electric vehicles, which is their core business. I don't know. Maybe they're going to sell millions of Optimus Prime robots or whatever the hell they're calling that thing, or driverless cars are going to be here next week for the last 5 years. Maybe that happens in 2025 and all of a sudden we get this massive growth from Tesla. But shy of any of that stuff, any of that sci-fi crap that Elon likes to talk about, shy of any of that happening, Tesla is in for a reset of its valuation, and it's going to be brutal. We saw a 6% sell-off in Tesla yesterday. And look, I got a lot of Tesla bros in this channel. A lot of people love this one. There's people who are always like piling into Tesla calls. Guys, look at the numbers. That's all I'm going to say. Don't look at prior stock performance and say that will continue forever. You got to look at what's driving that prior stock performance, and it sure as heck isn't Optimus Prime. So that's going on in electric vehicles this morning. Look, the EV bubble, it's bursting, guys. We've seen it. Or if it's not bursting, it's no longer inflating. You got to blow harder to keep it going. In related news, you've got Stellantis and Volkswagen are both under pressure this morning because they no longer qualify for EV subsidies here in the States. When the Inflation Reduction Act was passed, it included extensions for these EV subsidies for electric vehicles here in the States, provided that the batteries were manufactured and some of the battery materials were sourced domestically. And you guys may recall over the course of the last year, we saw a lot of these ambitious targets for EV domestic manufacturing went away. They went up in smoke, or at least they got delayed or outright canceled. And so Stellantis and Volkswagen are no longer going to qualify for those subsidies. That's a $7,500 or a $3,500 in some cases subsidy for those vehicles that's going away. And if people are already buying fewer electric vehicles, when they get $7,000 more expensive, well, they're probably going to buy even fewer on top of that. Now, there's a lot of bad news for vehicles this morning. That was Tesla, Stellantis, and Volkswagen. Hindenburg Research was out with another banger yesterday. They have been on fire this year. I've had a couple of big reports. You guys may recall Hindenburg's takedown of Supermicro earlier this year. Yesterday, it was Carvana. All right, the used vehicle retailer that somehow has saw their stock more than triple in the last year, even as the entire automotive industry has been in decline. See also Tesla, Volkswagen, Stellantis, all that other stuff. Somehow Carvana has exploded higher. They sell used cars. The price of used car has been double-digit negative in the CPI for the better part of the last year. And somehow Carvana is posting all this magic earnings growth. Where's it coming from? Well, the secret ingredient is crime. At least that's according to Hindenburg Research. They discovered $800 million worth of mostly subprime debt that was being sold to undisclosed third parties. Turns out Carvana, I almost said Tesla there, sorry. Carvana has been basically rubber stamping loans to people with horrible credit, like subprime, way subprime loans, to people who can't possibly pay it back. And then they're taking that debt and they're selling it. Now, the problem is the people that they're selling it to is actually either controlled by or owned by or somehow run by Cerberus Capital. That is the same private equity firm that gave us such hits as Stewart Healthcare. You may recall them. Well, they found out that this trust that has been buying up all of these awful auto loans is actually run out of the same office suite that's rented by Cerberus Capital in New York. $800 million of these loans. And on top of that, there's a massive pile of loans that have been given extensions. Now, those loans should have been sent into delinquency or into default, but these loans are serviced by an affiliate of this company called DriveTime. And well, DriveTime is run by the CEO of Carvana's father. So these are undisclosed third-party transactions that are being used to hide all of the losses of Carvana by passing them on to Cerberus Capital investors or by passing them on to the private books of this company, DriveTime, run by the CEO's father. And if you take those away, Carvana would be right back on the brink of bankruptcy where they were a year ago when the auto market was much stronger than it is right now. So look, Carvana, be careful with this one, guys. It's a very damning report, but Carvana is also one of those names that has very high short interest, and it's one of those names that's got a bullseye on it from the Reddit guys and the short squeeze guys. So look, the company is garbage, in my opinion. That was a damning report by Hindenburg, but the stock can still go up if a bunch of people just blindly start piling into it in order to squeeze the short sellers. So, this is another one where I'm just going to make some popcorn and sit back and watch. But that was a damning report by Hindenburg. Another good one from them. That's enough about autos. Let's talk about China. China's yuan has weakened past 7.3 to the dollar. That is an important line in the sand that the Chinese had been defending for years. And now it is gone. The yuan continues to weaken. China is going to weaken their currency to try to deal with this economic collapse that is ongoing. You got the CSI 300 shed another 1.2% yesterday. Now there's news that the Chinese government is going to subsidize smartphone sales. They're going to give people money to buy phones to try to stimulate consumption, i.e. they're going to keep printing money to try to make economic growth magically happen. They won't. They're just going to cause inflation. And why are they subsidizing smartphones in particular? Well, there's an article in CNBC this morning that says foreign phone sales in China are down 47% year over year. Foreign sales of smartphones in China have been cut in half in 1 year. And look, guys, that's got Apple written all over it because Apple makes up almost all of the foreign iPhone sale or the foreign smartphone sales in China. Samsung has a very small footprint in China. Huawei's big, Xiaomi's big. Apple is by far the lion's share of those foreign numbers. So when you're selling about half as many phones as you did a year ago, that's not good news for your stock. And remember, guys, Apple's up like 27% over the last 12 months, all because of this hype around the iPhone 16 and Apple Intelligence is going to be so amazing. And somebody said a thing about AI. Well, remember, their flagship product is the iPhone, and they only sold about half as many in China. I'm sure things are going to go great for that stock. Rounding out the morning, it seems President Biden is intent on blocking the Nippon Steel takeover of U.S. Steel. That's a $15 billion merger that's been in limbo for several months now. Look, I'm on the fence about this one. I could go either way. I don't like the government getting involved in business. I don't like the fact that they're trying to block mergers, but at the same time, not having a domestic steel industry would be catastrophic for the United States, especially as we seem intent on just blindly walking backwards into World War III. Well, it's kind of hard to wage a world war, especially one being fought on the seas, if you can't make steel. So if we're not going to let this Japanese company Nippon come in and take over U.S. Steel, we are essentially committing to subsidizing our domestic steel industry. I don't like that either. And so U.S. steel remains a topic of contention. Biden is set out to block it, although it's worth pointing out that President Trump has also come out against this Nippon takeover of U.S. steel. So that one was probably never really going to happen. So it's just a case of now what? What does this mean for an industry, domestic steel manufacturing, which has been in trouble for, I don't know, my whole life, the last 50 years or so? I'm not that old, though. Anyways, why don't we shrink my big melon of a head and let's see what's going on in the markets this morning, shall we? And guys, I didn't share my screen. Oh, my goodness, I am remiss. I did not share my screen. There we go. Don't forget that like button. And if you're new here, hit that subscribe button so you can come back and have your coffee with the Melon Heads tomorrow morning, because we do this one every day. And look, we've seen this the last couple of days. Stocks begin the day in the green, and then they end up closing deeply red. So, we got the bull thumbnail out again this morning because all three indexes were in the green when I posted this. S&P is up 23 points, 0.4% higher ahead of the opening bell. The Dow's having a good morning, up 0.38%, 163 points to the upside this morning for the Dow. And the NASDAQ is up 94 points, or 0.45% ahead of the opening bell. So stocks up across the board, just like they were yesterday before reversing those gains. Meanwhile, we've got the U.S. dollar is weakened somewhat this morning, but you may notice that 109 handle. U.S. dollar crossed above 109 yesterday. The dollar wrecking ball continues. This strengthening of the dollar is going to wreak havoc with the global economy, guys. We're already seeing it over in China. They're letting the yuan weaken further. You've got the Brazilian real is in trouble. You got the Indian rupee is in trouble. The South Korean won has always been in trouble. That's even worse. They tried to arrest their president yesterday. They couldn't do that. It's a mess, and it all translates into a stronger dollar. Keep an eye on that one, guys. It's putting downward pressure on asset prices, although you'd never really tell yesterday because the gold and silver were up big yesterday despite the stronger dollar. Somebody want to explain how that works to me? I don't know, but that's what happened. Right now, though, giving back some of those gains, still above 109, but just barely, 109.03 for the DXY. Meanwhile, yields are lower on the long end, a little bit higher on the short end this morning. The 30-year Treasury, 4.772. That's up 2.5 basis points. The 10-year's at 4.558. The 30-year is down 2.5 basis points, as is the 10-year, down almost 2 basis points. The 2-year, meanwhile, 4.243, down a half a point. And the 1 month is up 1 basis point to 4.324. Looking over at the commodities board, we got a mixed bag. Spot gold here, down $10. 2,647 for gold. That's about 0.4% lower. Meanwhile, spot silver is up by about 1% here, $29.86 for my favorite of the shinies. That's up 29 cents this morning. We've got coppers up about 0.9%. Platinum is up 2.4%. Palladium up by 1.3%. And WTI crude oil's at 73.45. That's up about 30 cents here, or 0.4%. We've had a little bit of strength in oil over the last few days. I'm seeing a lot of people talking about how maybe this is optimism about China. There was a lot of articles about how maybe all this stimulus in China is going to spur some economic activity, which is going to translate into some more oil demand. So people are trying to front run that by buying some oil futures. It's possible that's what's happening. But this whole China turnaround story resulting in more oil consumption, we've been hearing this for like 3 years, guys, and it still hasn't happened. So I'm a little skeptical of that narrative. Meanwhile, looking over at Bitcoin, it's a little bit lower this morning, although it had a really good day yesterday. Bitcoin is at $96,710 as priced on Coinbase. That's down about $200 from yesterday. Yesterday, though, we did hit a high of about 97,800 before settling around the 97,000 mark at the end of the day. It's a pretty good day here, but Bitcoin remains off its highs. Now, let's talk about the main story this morning, the big one. Tesla's annual EV sales dropped for the first time in over a decade. I believe this is the first time ever. I'm not so sure this over a decade thing is accurate. I think this is ever. The car maker's 2024 results come in slightly below the prior year. Tesla's annual vehicle sales dropped for the first time in more than a decade, despite a year-end push that sent deliveries to a record in the fourth quarter. In other words, they crammed as much of that stuff in to avoid this happening, and it happened anyway. It goes to show you things at Tesla are not that good. And depending how much they crammed into the fourth quarter, they may have actually cannibalized some of their first quarter sales. So these numbers could be about to look pretty bad. The Elon Musk-led company sold 1.79 million vehicles last year, it said on Thursday, which was slightly less than what it delivered in 2023 and also below the analyst consensus estimate. The results offer a sobering reminder of the real-world challenges for EV makers, even as hype around driverless cars and Musk's closeness with President-elect Donald Trump have sent Tesla stocks soaring in recent months. Lukewarm consumer demand is weighing on sales of electric cars, an issue that could be exacerbated by Trump's push to rein in EV incentives. And they showed this chart here on the Bloomberg article that just goes to show you, I mean, Tesla's vehicle sales, it's been a phenomenal decade for Tesla. These sales have grown year in, year out, and they've grown pretty substantially. A big leap in 2021 and 2022. Not surprising considering all the incentives that were thrown into EVs and all the subsidies. And then you notice how we have now stalled out. We've gone from 1.81 million vehicles in 2023 down to 1.79. Not exactly a huge decline. It's not like sales are plummeting, but they're not growing. And Tesla trades at 104 times sales, guys. When your stock trades at 104 times sales, or not sales, I'm sorry, 104 times earnings. When a stock trades at a PE of 104, you damn well better show some growth. And Tesla's going to have a hard time showing growth now. I don't care what they say about Optimus Prime or AI. They're not making any money with those things yet. So Tesla's growth, it's effectively gone. Stock lost 6% yesterday, although it's getting some of that back pre-market. It's up about 0.75% ahead of the opening bell, trading at $381.80. More bad news for EVs, though. Stellantis and Volkswagen drop after losing U.S. electric car subsidy. If they're already having a hard time selling EVs, well, losing the subsidies, that's sure not going to help things here. Stellantis and Volkswagen shares declined as some of their plug-in cars lost access to U.S. tax credits under tougher rules that took effect this week. Volkswagen's ID4 electric crossover lost its full $7,500 tax credit, according to the latest listings by the Department of Energy and Environmental Protection Agency. Models from the likes of Nissan and Stellantis that previously received as much as $3,750 are now also ineligible. There's more bad news for Nissan there. Pay attention to that one. I missed that my first roll through this article. Would this possibly play a role in this Nissan merger that's going on? Who is it? Honda's looking to buy Nissan and Mitsubishi right now? I don't know. But this is certainly not going to help things. Stellantis shares fell as much as 3.8% in Milan. Volkswagen stock declined as much as 1.4% in Frankfurt. The reclassification, part of President Joe Biden's Inflation Reduction Act, tightens domestic sourcing requirements for battery parts and the raw materials used to build them. The number of EVs and plug-in hybrids that currently qualify for a credit is 18 models. That's down from 22 last year. Now, the whole point of putting that language in the Inflation Reduction Act was to stimulate domestic production of electric vehicles. And, well, it didn't work because domestic production of electric vehicles wasn't stimulated. They're just putting a damper on sales now of electric vehicles in the U.S. Look, this is such a heavily subsidized industry. I'm glad they're getting rid of these subsidies. I don't think we should be subsidizing vehicles like this. That being said, it's not going to help, man. It's going to add to the problems in the car industry. Now, one company that has been strangely resilient in the car industry over the last year has been Carvana. And it turns out, well, the secret ingredient is crime. Carvana slammed by Hindenburg, and the stock pauses its meteoric rise. And that meteoric rise amid all the mayhem in the auto industry last year should have been a dead giveaway that something was majorly wrong at this company. But, you know, nobody likes to ask questions when the number's going up. Trust me. Trust me. Nobody likes questions asked when the number is going up. But then everybody says, how could they let this happen when the number starts going down? I'm beginning to think these two things may be related. Carvana's turnaround is a mirage, the short seller says. Carvana stock closed down 2% lower on Thursday after a scathing short seller report called the company's turnaround a mirage, after initially adding to gains that have topped 300% in the past year. Auto industry is in turmoil, and this stock adds 300%. And nobody was like, gee, someone want to look at Carvana maybe? This is why we have these short selling firms. They do a public service. Hindenburg Research said it poured over documents and interviewed former Carvana employees, experts, and competitors over 4 months, uncovering $800 million in loans, sales to a suspected undisclosed related party, along with details on how accounting manipulation and lax underwriting have fueled temporary reported income growth, all while insiders cash out billions in stock. Now, that $800 million in loan sales, it was to this vehicle trust that has an address is listed as this building and this 10th floor in New York. That entire floor is rented out by Cerberus Capital. And so it looks like Cerberus Capital is the company that has been buying this $800 million in mostly subprime loans from Hindenburg Research. Now, the problem is Cerberus Capital, one of Carvana's directors, Dan Quayle, yes, as in the the great intellect, our former vice president, Dan Quayle, that guy. Well, he's one of the directors at Carvana, but he is also the chairman of global investments at Cerberus Capital. So what's going on? Carvana is hiding losses and stimulating their revenue by dumping all of these bad loans onto Cerberus Capital investors' books, because one of the company's directors just happens to be the decision maker over at Cerberus. Well, that is an undisclosed, related third-party transaction that the company is hiding. But that's not the only thing. Carvana, an online used car platform, they didn't immediately return a request for comment. Hindenburg painted a different picture on Thursday. Besides highlighting the loan, the report called attention to Carvana's valuation and premium and the company's about $4.8 billion in net debt, and said that the business faces major headwinds as used vehicle prices have declined. More on that in a minute. The short seller also highlighted stock sales by Carvana CEO Ernie Garcia III's father, Ernie Garcia II, saying that as insiders unload stock, the company's solvency risks remain. Ernest Garcia's father has sold hundreds of millions of dollars in stock over the last year or so, as his company has helped hide Carvana's losses. Almost 26% of Carvana's gross profit consisted of sales of customer auto loans to third parties, largely in the risky subprime and deep subprime space, Hindenburg said. Carvana last updated investors in October, reporting a blowout third quarter, during which sales jumped 32% and calling for 2024 profits at the high end of its guidance. Now, another thing, it's not mentioned in this Market Watch article, but a big feature of that Hindenburg report was the fact that they're granting extensions on loans that should otherwise be sent into default. In other words, extend and pretend. The same avoidance of price discovery that we're seeing in commercial real estate, they're doing it in used cars. Gag me. It's not something that holds its value, guys. The loan servicer that Carvana used, it's an affiliate of this company, DriveTime. Now, DriveTime is run, the CEO of DriveTime is Ernest Garcia II, Carvana's CEO's father. So what they're doing is they're hiding losses that would show up on Carvana's books. They're hiding them on the books of the CEO's father's private company, and they're also hiding them on the books of Cerberus Capital, which is being run by one of their directors. They're exporting their losses to unsuspecting investors and third parties. And of course, what has happened? Well, Carvana has posted amazing numbers, and their stock is up 277% in the last 12 months. The thing has more than tripled. Well, it's not doing so good this morning. It was down 2% yesterday, and it's down another 5.5% this morning. So it looks like investors are finally starting to pay attention. But look at this stock over the last year, right? Look at what the stock has done. It's more than tripled. And then look at the Manheim Used Vehicle Value Index. All right, now this isn't the same time horizon, but pick this up like mid-2022. Look what used car prices have done over the last year or so. How in the world did Carvana stock triple while this was going on? And how did nobody ask these questions? It's pretty obvious Carvana has been hiding their losses. You've got loan delinquencies are on the rise. See also Ally Financial and Capital One and some of the dreadful numbers in auto loans that have been coming out. And then look at what the value of the vehicles have done that are insuring those loans. You've got loans are going into default. The assets backing them are losing value. And the company that sells this stuff is supposedly tripled? No way. No way, guys. This one, dead money right here. But again, be careful, guys. If you're tempted to pile in and short this one, just know that the apes have their sights set on this one. And this thing, they could engineer a squeeze. You got to be careful. All right. Also, let's talk about China this morning. A lot going on here. China lets yuan weaken after defending 7.3 per dollar for weeks. More news about China, guys. China was in the headline for 2 days in a row. There's a little bit of China fatigue. I'm sure there's a lot of China fatigue in China. They're probably sick of making headlines. The onshore yuan weakened past the level that China had been defending throughout December, opening up room for the managed currency to drop further amid a sluggish economy. The yuan breached the psychological milestone of 7.3 per dollar for the first time since late 2023, amid concerns over China's economic struggles and a widening bond yield discount to the U.S. The move came even as the central bank maintained its support for the currency with its daily reference rate on Friday. Looking ahead, China's economic fundamentals point to further depreciation. Risk sentiment is so poor that the benchmark stock index closed at the weakest level since September, and sovereign yields hit fresh record lows. U.S. President-elect Donald Trump has also threatened to impose tariffs on Chinese exports. In November, the country already suffered the biggest outflow on record from its financial markets. Now, this is kind of interesting, guys. Take a look at this chart. This is USD CNY, the number of yuan it takes to make $1. Now, this red line here, apparently I drew this over a year ago. When I opened up this chart this morning, that red line was already there from the last time back in 2023 that we were talking about the yuan depreciating. So I didn't even have to redraw the line here. But you will notice, check it out right here, guys. How do I get rid of this? There we go. Oh, come on. TradingView is giving me a hard time this morning. I'm trying to make, there we go. Anyways, right around the red line, you can see how we've been kind of hovering right around this level. That has been the Chinese central bank defending this level. They've been selling their dollar reserves and buying their own currency to prevent it from going above this level. And they finally threw in the towel on that this morning, and they're letting the yuan depreciate further. Now, if we zoom way out on this chart, you can see here, we've been here before. They defended this level in November of 2022. They defended this level for a long time in the late summer of last year. That's when we drew this line. And now we're letting it fail here today. So it looks like we're heading for new lows in the yuan. Now, that's going to make Chinese exports a little more competitive. And so it's possible that they are manipulating their currency lower as a way to offset the tariffs that are probably coming from the Donald just as soon as he takes power. So China's manipulating their currency to offset tariffs and a weaker economy here. Also worth pointing out, guys, the CSI 300, that's the Chinese benchmark index. It lost another 1.2% yesterday. That is 3 days in a row of significant declines. It's the lowest level since mid-October. We've now given up about half of these big gains that we saw after the announcement of stimulus from the PBOC. Things in China continuing to get worse. And we've also got this one. Shout out to my moderator, Mish, caught this one this morning. China's central bank calls in mutual funds to flag bond investment risks, sources say. Pay attention to this one, guys. China's central bank summoned some fund managers on Friday to warn against frenzied buying of government bonds that has driven yields to record lows, two sources told Reuters. Such meetings between the PBOC, that's their Fed, and institutional investors aimed at flagging bond investment risks have become regular recently, occurring several times a week, said one of the sources. The scramble for bonds as investors seek safer assets and a bet on lower yields not only undercuts Beijing's efforts to channel money into consumption and more productive economic efforts, but also raises the risk of a bubble in debt markets. That last bit there, very important, raises the risk of a bubble in debt markets. We've seen this here in the States. We've seen this in the UK in just the last couple of years. When you see a big decline in interest rates, that means people are piling into bonds. They're buying a ton of bonds and they're bidding up prices. That is it. When that reverses, if that were to suddenly stop and interest rates were to reverse, like happened in 2022, that's how you end up with Silicon Valley Bank failing and Signature Bank failing, all those big losses on U.S. treasuries, right? China is worried about the same thing happening here. There's this flight to safety in China. Everybody's buying bonds. And the PBOC is calling their hedge funds and they're saying, hey, stop doing that. That's our job. We're the ones who are supposed to be buying bonds. You guys give your money to people to buy iPhones. Apparently, that's what the message is. You check out this next article. China to subsidize smartphone purchases in a bid to lift spending. Yikes. China will expand consumption subsidies to cover smartphones and other electronics in a step to promote domestic spending as external headwinds pick up. Those headwinds are not external, guys. This is not because of tariffs that all this is happening in China right now. The tariffs will make it worse. but China's economy is collapsing because of their housing market. A national trade-in program that currently applies to home appliances and cars will broaden this year to include personal devices like phones, tablets, and smartwatches, officials from the nation's top economic planning agency said in a briefing Friday. Chinese consumers in the post-COVID era have begun holding on to their smartphones longer, given a lack of exciting new features and general belt tightening. A lack of exciting new features. So much for that exciting new iPhone 16. As with cars and washing machines, investors hope incentives will revive the world's largest smartphone market and drive sales for not just brands such as Huawei and Xiaomi, but also galvanize business on platforms popular with device fans like Alibaba and JD.com. So as China is looking to subsidize smartphones, we also got this one in CNBC. Foreign phone sales plunge 47% in China, spelling trouble for Apple. That's 47% in 1 year. That is a huge decline. Sales of foreign phone brands in China plunged in November, according to official data released Friday, underscoring further pressure on Apple, the biggest international handset vendor in the country. In November, foreign mobile phone shipments in China stood at 3.04 million units, according to CNBC, based on data from the China Academy of Information and Communications Technology. That's a fall of 47.4% from November of 2023 and a 51% drop from October of last year. CAICT does not break down figures for individual brands. However, Apple accounts for the majority of foreign mobile phone shipments in China, with competitors like Samsung forming only a tiny part of that market. And guys, big declines in foreign phone sales in China, and yet look at what Apple stock has done over the last 12 months. It's up 27%, while its flagship product has been sinking. All right, now the stock's down 0.5%. Yet this after the open today, it's $242, down about $1.40. But all this enthusiasm in Apple, I think it's been AI related. Apple Intelligence is not selling iPhones in China. I can tell you that. I don't know how it's doing in the US. Maybe some people are buying it. I don't know. It's a slightly better Siri. Hey, Siri, are you guys any good? Sorry, everybody's phone just lit up who's watching it. Mine did too. Anyway, not good news for Apple this morning. All right, last one I'm going to talk about here. I know we're getting a little long here. Biden declares to block Nippon Steel's $15 billion acquisition of U.S. Steel. Look, guys, I don't have a lot of time to get into this. Let me just say that I could go either way on this one, all right? I have a hands-off approach when it comes to government and business. I don't like to see the government blocking mergers. At the same time, I don't like to see the government subsidizing industries. And if they don't allow this merger to go through, the U.S. government is probably going to end up subsidizing U.S. steel, because you can't let your domestic steel manufacturing go. That is a strategically important industry that you need to maintain in your country. If you don't have steel manufacturing and something like, a ground war in Europe or a naval conflict in the South China Sea were to erupt and you can't make steel, you've got big freaking problems. So we're probably going to end up subsidizing this industry now. So, I don't like either outcome here. Biden is opposed to it. Trump is opposed to it. There's something here for everybody to like, and there's something here for everybody to dislike. This $15 billion deal, not happening now. I just want to say thank you. So, hey, Travis, what's going on, brother? Real Estate Mindset says, love your great work, brother. Thank you so much, Travis. It's good to see you, buddy. Hope all is well with you and family. Guys, check out Real Estate Mindset if you have a chance. Thank you so much, brother. Charles G says, does Cerberus Capital deal with pensions? I don't know specifically if Cerberus Capital deals with pensions. They're a private equity firm. I'm sure some of their products are on the balance sheets of some pension somewhere. Like CalPERS is so big, they own a little piece of everything. I don't know any specific examples, though, of Cerberus products that are in pension funds. But Cerberus does deal with a lot of other people's money and investment capital. And I wonder if those Cerberus clients understand that their money is being used to hide losses from this chop shop of Carvana. I don't know. I think Dan Quayle has some questions to answer. Dan Quayle, who had that on their 2020s bingo? Dan Quayle possibly involved in corporate fraud. Oh man, this year we're 3 days into 2025. It does not disappoint. Thank you very much, Charles. Dan Hadeen says all the automakers are pulling back on their EV investments. GM sold their half of the LG partnership battery plant to LG. That's right. We were talking about this on the Zoom. It was like 2 weeks ago, I think, Dan. We were talking about this on the Zoom meeting. Look, the EV bubble, they just got too out in front of their skis, right? Or too far. What's my acronym? Too far over their skis. They got too far out in front of this. Whatever. It's a bubble, right? EVs, they make sense in the cities. They don't make sense for people that live anywhere else because of the range limitations and the lack of charging infrastructure. Now, charging infrastructure is improving, as is the range, but it's still not there yet. And electric vehicles are more expensive at a time when regular vehicles are already too expensive. Interest rates are too high. This is a very predictable outcome. So I'm not surprised to see the automakers scaling back their EV investments. I wonder what's going to happen once the Donald takes over. He's not going to be big on the subsidies. He's probably going to try to pull back a lot of the Inflation Reduction Act stuff. But again, all that big relationship with Elon and that complication, I don't know what that's going to look like. All I can tell you guys is I'm not touching EVs right now. I've never been a big fan of EVs, and that hasn't changed. Thank you so much, Dan, for supporting the channel. Hopefully I see you this afternoon on our weekly Zoom call, by the way. Also, thank you. Uncle Fetzer says, happy Friday, Jack. China Observer has a video stating that China was experiencing a lot of EV fires, 21,000 a year. Well, let me just say, I'm a big fan of the China Observer channel. That being said, China Observer is very bearish, all things China. It's worth at least verifying. I don't want to cast any shade in their direction, but they're so bearish, it's worth exploring the other side of whatever they're talking about. I don't know if I put that gentle enough, but I do subscribe to that channel. I love their videos. They are fantastic. And EV fires, I can tell you we're having a lot of EV fires also. And in China, like Chinese manufacturing and quality don't really go hand in hand. So if we're having problems with EVs made here, I guarantee you they're having even bigger problems with EVs made over there. That's another reason why I'd never buy an EV, guys. Have you ever seen what happens when an EV catches fire? I'm not going to park one of them in my garage right below where I freaking sleep. Heck no. So yeah, my opinion on EVs remains unchanged, guys. I've always been very bearish EVs, but yeah, maybe things worked out really well for Kathy Wood and her investments in electric vehicles over the last few years. Thank you so much, Uncle Fedster. Shout out to China Observer as well. Armando Reyes says, place your bets. Will Elon be the first to get a contract with the Pentagon to build some type of stormtrooper or robot army? Oh man, we're getting dystopian here. I'm sure it's coming. I'm going to put my money on somebody like an Anduril for that one, though. Maybe Tesla, maybe not. Interesting, though, by the way, yesterday, the government had a big deal. The Government Services Agency, or the GSA, had like $1 billion deal that they cut with Constellation Energy. That's my former employer, by the way. I used to work for them. Don't hold any stock or anything in them. But the government is buying $1 billion worth of electricity from a utility company. Is the government running one of these massive data centers? Is that what this is? Was this a deal that they're cutting to try to buy electricity at below market rates from public utilities in order to power their data centers at the expense of higher retail electricity prices elsewhere? I don't know. Maybe that's worth looking into. Seems like a lot of these deals cutting out the middlemen to power data centers are happening lately. And we're supposed to have deregulated environments where that doesn't happen, where the utilities sell their power into the grid and then everybody buys their power from the grid and you're not allowed to cut out the grid. I thought that's how we run our power grids now, but it seems like these side deals are becoming a regular thing. I don't know. Keep an eye on that one. Thank you, Armando. Appreciate the super chat, sir. And thank you to Nick Colbert, who became a new YouTube member. Did I see that right? Is he a Magnanimous Melonhead member? He is. Well, Nick, thank you so much for upgrading your membership to Magnanimous Melonhead. I appreciate that very much. By the way, we'll see you this afternoon, time permitting. I believe, was it 2 p.m.? Let me check real quick. I forget what time it is. We are doing our weekly Zoom today at 2 p.m. And so hopefully I'll see you there. There's links down below. If you check the community tab, Nick, you will see that one under Magnanimous Melonheads. Thank you so much, Nick, for supporting the channel. Thank you, everybody, for the super chats, for supporting the channel, as well as for having your coffee with the Melonheads this morning. I appreciate that very much. Thank you very much also to Nick and my other Magnanimous Melonheads on Patreon and YouTube for everything you guys do for the channel. You guys rock. Links down below should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Don't forget that like button on the way out and that subscribe button. And everybody, till next time, live small and dream big.